Welcome back to the show, everyone. Thank you so much for joining us. You know, mortgage interest rates are remaining at all-time lows. Now is definitely the time to buy a home or refinance an existing mortgage. But what type of loan is best, a fixed or adjustable rate mortgage? Joining me now is our financial expert and certified mortgage planner, Monique Runge. Thanks for being here, Monique.
Thank you.
Of course. Okay, so which is better? Tell us the difference. Fixed or...
Well, it all depends, of course. I mean, every household's financial situation and their real estate goals are going to vary. But what's important to point out here is that, first of all, we've all been raised through generations educating us fixed rate mortgage. Got to get a fixed rate mortgage.
Yeah, because the people that didn't have that a couple years ago got in a lot of trouble. So how do we know? First of all, what's the difference for those people that maybe are not so familiar?
Well, I mean, a fixed rate mortgage is going to give you the fixed interest rate for the life of the loan, whether it be 10 years, 15 years, 20, all the way up to 30. And ARM, which is an acronym that stands for adjustable rate mortgage, will generally give you a fixed rate for the first, say, 1 to 10 years, depending on the type of loan you choose. And then generally after that, through the rest of 30 years, goes into an adjustable rate. So the rate could go up, it could go down, it could stay the same. So yeah, there's risks involved, but there's also some great benefits too. So basically, the decision entirely depends upon really, you know, if you're a first-time home buyer, for example, most people are getting FHA loans. So they're getting minimal down payments, they're just getting in the door, they're buying their first house. But statistics show that first-time home buyers mostly stay in this home for maybe 3 to 5 years. Life changes. You get an increase in income, priorities change, you start growing your family, you're going to move up in house. So getting a 30-year fixed rate mortgage as your first loan on your first home is not always the best advantage. Because you're paying for that long-term security when you're really not going to stay in that. You might not stay in the house or you might not stay in the loan. So it just depends.
Let's talk about the scenario that we have here up on the screen. Back in 2003, you say a police officer and his family came to you wanting to become approved to purchase a home.
Correct. Correct. So this family was wanting to purchase a home, and they were looking at a home for $300,000. Back in 2003, 100% financing existed, so we got them the loan for $300,000. And we did a side-by-side comparison. We looked at a 30-year fixed-rate mortgage, which was offering a 6.25% interest rate at that time. The PITI payment was $2,604. Now, we also looked at the 5/1 ARM, which means the first 5 years, the interest rate would be fixed at 4.75, which gave them a payment of $23.22. So the monthly savings with the adjustable rate mortgage was $282 a month times 60 months, which is 5 years, was almost $17,000. Look at that, $16,920. So big savings. So I encourage them to go with the 5/1 ARM on this particular purchase loan and use that monthly savings because they had a pool and a big backyard, and all of that runs into extra expenses as well. And it just wasn't cost beneficial to do the 30-year fixed. Now, fast forward 2008, it goes into the adjustable rate period. Oh my gosh, what are we going to do? You know, so I contact the client a month before it goes into the adjustment, and I say, let's do a financial analysis again. Refinancing to a fixed rate, or maybe letting it adjust. It might behoove you. So when we did that comparison, it proved that if they went to the fixed rate, their payment was going to go up. Whereas if we stayed in the adjustable rate, their payment was actually going to go, it was going to be lower than the fixed rate. So here's the cool part. I advise them to stay in their remaining adjustable rate mortgage and look at what this advice saved them. So 2008, their interest rate increased, as you can see, to 5.5, and their new PITI payment was $19.46. Now, we had a substantial savings here because we removed private mortgage insurance without having to refinance. So their annual savings in 2008 was over $4,500.
Wow.
Then, fast forward again, 2009, did the same analysis. I advised them to stay in that loan. Look, it went down 1.25 points down to 4.25. Their new PITI payment was $300 less, and they saved $3,600 for the year.
Wow.
And 2010, it's still too early to tell, but based upon current market conditions, that adjustment could go down again, potentially saving them over $7,200.
What I'm seeing here, Monique, is that people really definitely need help when it comes to getting informed on when their adjustable rate is coming up. And I believe that this family really took advantage of the fact that you were helping them, because how are we to know? I mean, so really it's very beneficial to people to have someone like yourself, a mortgage certified planner, to help in each and every process. So give Monique a call, whether it's to ask questions or for information.
Yeah, I encourage viewers to contact a certified mortgage planner. I hope that you will call me. And here's the thing is, we can establish if we can uncover any monthly or annual savings. And we also teach people to use their mortgage as a tool to create overall wealth.
Wow. All right. So your phone number, very important, 433-9447, 433-9447. You can also contact her through the web at MoniqueRunge.com. There it is, MoniqueRunge.com.
You got that right.
Exactly. Yay, I practice. All right. Thank you so much, Monique. I sure appreciate it. MoniqueRunge.com. Love it.
Pleasure.
See you next time.
Yeah.
I love those scenarios. Thanks so much.
You.
Stick around, folks. Central Valley Today. We'll be right back.